Everybody's talking about Bob Iger selling a bunch of Disney stock again. Now, we cover this usually almost every year when he gets awarded stock as part of his typical ongoing executive compensation at Disney, but this is something different that we need to talk about because people are just kind of missing some key information here. Yeah, Bob Iger's planning to sell a bunch of Disney stock, but what you probably didn't understand is that he's actually got to buy it first. This is a story that it's really not that big a deal, but it's a big deal in the sense that we need to explain it. So this is what was going around this week. Walt Disney Company CEO Bob Iger sells $42.7 million worth of company stock. Now, that is relatively true in the sense, yes, he did dump 40-some-odd million dollars, or was set to dump 40-some-odd million dollars of Disney stock. Now, you've heard us talk about some of these situations in the past.
I was going to say, isn't this something he does every year, basically, because he has to get rid of so much?
You're right, Tom, but this one's a little bit different. You're absolutely right. We've talked about this before.
So tell us how it's that different.
So in this case, Bob Iger had to buy it, not sell it. He had to buy it first. So
how much does it cost? Bob buys it.
So in this case, unlike the routine sale of Disney stock for Bob. So most Fortune 500 company CEOs, as part of their compensation, apart from cash, which is usually, honestly, the salary is the smallest portion of a CEO's compensation. Usually they get it in the form of stock, treasury stock given to him from the company. And usually that stock will largely get liquidated by that executive almost each and every year. And the reason for that is because, especially here in the United States, let's say a guy like Bob Iger gets paid $1 million a year cash to be Disney CEO. And he gets paid $20 million a year in Disney stock as compensation, a non-cash compensation. Well, the issue for a guy like Bob Iger or anybody else out there on Earth is that when they get that non-cash compensation, guess what, kids? The Internal Revenue Service here in the United States, the IRS, you know, the guys we all love, they still treat that as cash compensation. Even though it's non-cash compensation, the IRS is still going to tax a guy like Bob Iger on that as income. So Bob Iger made, for example, $1 million in cash salary, and he made $20 million in stock. The IRS is still going to tax him on $21 million of income for the year. So a guy like Bob Iger, at his tax, at his income tax level, is at about 37%, plus another 10% or so for the state of California. So nearly half, 50%, is what he's going to pay on that. So Bob Iger is going to have to sell, like most executives, that stock each and every year to raise the cash, because you can't pay the IRS in shares of Disney. You got to pay the IRS in cash. So as soon as the stock becomes available to liquidate, a guy like Bob Iger is going to sell it, pay his tax burden, and move on. Maybe he reinvests in some Disney shares. Maybe not. So we've set up the fact that the sale of stock by CEOs, be they Bob Iger or otherwise, is relatively routine, as they are routine parts of their compensation each and every year. But what I want to make clear is that what's going on right now is not that situation. This is something very, very different. So let's read this from Variety, because I want to make this clear for everybody. Bob Iger, chief executive of Disney, cashed out a chunk of his stock options. Different situation, worth $42.7 million, according to a regulatory filing. Of course, that regulatory filing is with the SEC, the United States Securities and Exchange Commission. Bob Iger sold 372,000 shares of Disney on November 22nd, with an aggregate market value of $42 million, according to an SEC filing. Those shares were vested stock options Iger was granted in 2014, 10 years ago, that were set to expire in December, like in a couple of weeks from now. He exercised the options under a trading plan adopted last week Note that Iger, and this is key, note that Iger is not pocketing $42.7 million. The options granted in 2014 have an exercise price strike, and it's all right here in the articles for anybody who bothered to read it, a strike of $92.24, which is the price at which he could buy the shares. All right, so here we go. Disney closed the other day at $115 per share. So let me explain how this worked. All right, so everybody understands. Bob Iger didn't walk away with $42 million. Bob Iger walked away with about $4 million. Here's how this works. In 2014, as part of his executive compensation renewal, Bob Iger was granted stock options. This is different than actual shares of stock that Disney would convey to Bob Iger each and every year as part of his executive compensation package. Here it is. Walt Disney Company. Okay, let's go to the advanced chart. Let's go out here to 2014. December of 2014. $91 a share. Okay. So that's according to this, just to show you how little Disney has moved in the last nearly 10 years at this point, okay? That's been kind of the problem. Bob Iger had stock options, the strike price of which was 92. Now, I don't know if this was granted exactly in December. It might have been granted before then with an expiry. I mean, look at where it was here in January of 2014. It was at $80 a share. This is my point. What you have to understand about a strike price on these options is this. Bob Iger was given the option to buy 372,000 shares. This was largely part of his options that he was granted 10 years ago. Now, those options are also known as derivatives of the actual stock itself. So he didn't get the actual stock. But the way an option works is, in this case, Disney, as the issuer of the option, has an obligation to act on whatever they're offering the buyer. In this case, Bob Iger. Okay, Bob Iger is the holder of this option. Bob Iger, as part of his compensation, was given the right, if he so exercised it at his discretion, to buy 372,000 shares or thereabout, in this case, of Disney stock at a strike price of $92 and whatever cents, $92.24 a share. So Bob Iger sold $42 million worth of shares of Disney, but he had to buy each one of those shares first at $92.24 a share, which amounts to about $32 to $33 million. Now, here's the deal, and this is why this had to happen quickly. Obviously, the options contract was set to expire. If Bob Iger did not exercise this option, the option contract would have expired worthless in a couple of weeks, meaning it's gone. If Disney stock was still floating at $80 per share, the options right now, with a strike price of 92 and some change, would be what's called out of the money, meaning that there would have been no reason for Bob Iger to exercise the options. It would have been stupid, because why would you buy Disney stock from Disney at $92 a share when you could go out on the open market and buy it for $80? Which is what it was just a couple of months ago. You wouldn't do it. But if Disney right now is trading at $115 a share right now on the open market, and you had a call, you owned a call in your hand that you could force the seller to sell you that $115 per share stock at 92, well, you damn well would exercise it, because you're way in the money. So that's what Bob Iger did. He's been sitting on this options contract for 10 years from the Walt Disney Company. Now, most options contracts out there, obviously, are derivatives that are based in the secondary market, meaning that, Joe Average or an investment bank would sell an options contract to somebody else. Somebody else would buy it for a couple of dollars, and they would debate whether or not to use it or not trigger it based on where the underlying stock would go, whether it's Disney or NVIDIA or Apple or Walmart or whatever. But in this case, this is an options contract effectively that's been issued by the company itself from, in this case, treasury stock held by the Walt Disney Company. So Bob Iger exercised his options contract, and Bob Iger had a choice at that moment. If I exercise this options contract, I've got to come up with $33 million in cash money to buy the stock from the company that I run. I've got to come up with $33 million to buy the stock from Disney. I can either do that by selling stuff I already have, because I doubt Bob Iger has $33 million in cash lying around. He's probably got it invested, meaning that Bob Iger had to either sell something that he already owns, like maybe he's got Apple stock or Nvidia stock or whatever. He's got to sell something to raise the cash to buy this from Disney, to exercise this option, right? Maybe Bob Iger said, I don't want to sell it right now because I'm going to get hit with a massive capital gain on that, and then I'm going to have taxes on this stuff when I buy this and sell it from Disney too. I don't want to do that. What probably happened here was that, I would assume, that Bob Iger effectively went on margin to buy this. In other words, Disney, nearing the expiration of this, they came up with a plan, as they talk about here, a trading plan adopted last week and filed with the SEC. Basically, what would have happened here is that the Walt Disney Company would have effectively loaned Bob Iger the 380,000 shares or what have you that he would have had to otherwise buy and then immediately turn around and sell. And the way things work on the market, and this is the reason why they work this way, is because this is how margin is. When you buy or sell an equity, in this case, you usually have a settlement date that is, let's say, 2 days later. T+2, T+1, T+3. Some things are still T+5. Meaning, if Bob Iger entered into a transaction to, number one, buy these shares from Disney on Monday, and then immediately turn around and sell them in the same trading day, he actually would not have had to have come up with the cash to buy them, to settle the trade for the buy for a day or two, which at the same time, on the same day, he would have received the cash back from selling them. So they would have washed. So Bob Iger, in other words, effectively, between what he would have bought these Disney shares for at 92 a share and sold them for at 115, Bob Iger probably made somewhere between $8 and $10 million on the trade. That's it. That's what he would have netted out at, because he had to buy the shares first and then sell them. And then Bob Iger, of course, is in the 37% income tax bracket. He did not hold these shares of Disney for more than 365 days, so the IRS considers this a short-term capital gain, which means he's taxed at ordinary income rates. And this idiot lives in California, where he gets to pay roughly another 10%. So of the $8 to $10 million in profit, quote unquote, that Bob Iger made on this trade based on his option contract, he then would have coughed up nearly half of it in taxes. So in other words, Bob Iger walked away with about $4 to $5 million.
Wow.
There you have it.
I'm sorry I asked.
Well, Valiant, he also he had the option of holding on to this for the transaction to go through up until December 18th. So what do you think of the idea that he pulled the trigger now, just before the Moana movie comes out, just as they were making the very unpopular Disney World announcement regarding Disney Hollywood Studios? Do you think that volatility played a part in them making this transaction happen now versus waiting until later in December, when a lot of people are looking at the stock market and feeling pretty good?
Well, that is true, but when you're this close to the edge of this options contract, you need to make a plan now. Plus, it's harder for guys like Iger because, of course, they are, they're considered an insider, right? That you have far more disclosure, advanced disclosure, things like this, things you have to file with the SEC. Legal may have looked at this and decided, let's go ahead and do this now in a structured way in advance of the termination of this options contract, so that we don't look like we're maybe front running on things, which is a big no-no in the market. And also, I mean, if you're Iger and you're looking at this now saying, hey, it's $115 a share, the last 2 years that we've gone through a first quarter earnings report that they just did, and then things have kind of gone downhill from there. Maybe you would sell it right now. You kind of have to wonder. You have to wonder if Bob Iger actually had the ability to sell or to trigger this options contract 3 years ago when Disney was $200 a share. See, that's what makes me.
I find it interesting that Iger had a window of time here We just did the earnings report, and many people looked at that earnings report and said, you know, that future modeling that you have for Epic Universe that makes it look like your most valuable asset is going to perform really well.
Yeah.
We're questioning that, but investors have not. And it just seems interesting to me that they came out with that earnings report with that sus forward modeling, and all of a sudden he sells it just afterwards. I just think it's interesting.
I think it is too. And what I don't know enough about yet, I have not had time this week to dig into it. I mean, typically with options contracts, so if you know, Joe Average goes out there and let's say, hey, I'm going to either buy or I'm going to buy an options contract. Let's say I'm going to buy a call on NVIDIA or Apple, right? Let's just use NVIDIA. Let's say I'm going to buy an options contract on NVIDIA, and that options contract has a strike price of $200, and the options contract is for 6 months. I mean, that's fairly common for an options contract. But again, that's secondary market. That's not part of executive compensation that would come from treasury shares. Very different worlds, but the principle here is the same. I'm buying that options contract. NVIDIA is trading, at like $140 a share, $145 a share right now. So I'm going to pay, let's say, $3 for an options contract for 100 shares of NVIDIA at 200. Am I going to trigger that contract right now at 200 when it's trading at 145? Hell to the no. Why would I want to pay $200 for NVIDIA when it's trading at 140? But what I believe is that 6 months from now, or more importantly, within the next 6 months, NVIDIA is going to break through 200. And I'm going to push a button on that contract and force the guy that sold it to me, the initiator, to sell me NVIDIA for 200 a share when now, 5 months from now, it's trading at 250. I'm in the money, and I'm going to make a fortune on that one, right? So that's kind of the same principle here. So what I have to wonder is that, like, did this options contract from 10 years ago? Because this is very common for CEOs like this, right? You want to give a CEO not only stock each and every year as part of their compensation because it makes it more cash efficient for the company, but you also want to give them options because it incentivizes them to grow the company down the road. Hey, we're going to give you an option to buy more Disney shares at a fixed price, no matter where it goes. So if you perform well as a CEO and you drive our stock price up at Disney to $150 a share, we're going to give you a right in the next 10 years to come back and force us to sell it to you from the company at 92, which is what happened here. What I'm curious about is why Bob didn't trigger this before. I don't know if there was something in the options contract that said he had to wait, a certain amount of time. Options contracts that are structured like this are different than what you have in the secondary market between two Joe Average traders, right? There may have been a golden handcuff here for Bob that said he had to wait. It's like a 10-year contract, but you've got to wait 9 years before you can trigger it. Or so, I don't know. It'd be a little odd. It's a little bit deeper in the weeds, but he's decided to trigger it now. He's waited till effectively the last minute. Because again, if Iger didn't trip this in the next couple of weeks, it would expire. Worthless. So it's good for Bob that Disney is magically back above $92 a share for the first time in a while in the last couple of months.
Just in time.
We can speculate on that one. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.